Wall Street's rocky start to the year calmed down a bit Friday with a strong jobs report for December. The Labor Department reporting 292,000 jobs were added last month, while numbers for October and November were also revised higher. So what does this mean looking ahead to 2016? Steve Wood is Chief Market Strategist at Russell Investment Group. He joins us now, as does Wall Street Journal Chief Economics Correspondent John Hilsenrath in Washington. Gentlemen, thanks to both of you for being with us. Steve, I'm going to start with you. What do these numbers tell you about the overall strength of our economy?
I think the numbers are strong, much stronger than expected. And I think more importantly, to some degree, is that the revisions were rather significant as well. So some of the worries about the labor market were revised away. The initial take that we got for the month of December were reasonably strong. So I think that the labor market is going to feed into the Fed's decision, and that is probably the biggest contribution it's going to make. But
before we get to the Fed, are there certain sectors that stood out for you, both in terms of strength and weaknesses?
Well, I think the ones that are going to continue to dog the market are going to be energy. That's going to be very consistent, very significant downward trend. I think construction is beginning to stabilize a little bit, and I think some of this capital-light industrial manufacturing component of the United States, I think, is going to be a new component of the economy going forward.
Okay, great. Now, John, the other part of all of this, of course, wage growth, still not great. Yeah. Do these latest numbers reinforce the persistent worry around wage stagnation?
Well, I think we're seeing some signs that wages are picking up a little bit. On a year-on-year basis, they were growing 2% at this time last year. Now they're closer to 2.5%. But it's nowhere near what it's been in the past, and what the Fed wants to see, to have some sense that that the economy is really growing robustly. So, yeah, I think that's I think it's a real nagging problem. A lot of people thought wages were going to pick up in December. Instead, there was a little bit of a drop. I think there's some seasonality issues in the data which complicate things. I think we're seeing a little bit of an increase, but there's just not enough of it at this point.
All right, so John, how do you think then the Fed is likely to respond to these numbers, both when it considers interest rate increases at the end of this month and then again in March?
Well, so I don't think they're doing anything at the end of this month. There isn't enough distance between their last move in December. They have a puzzle that they've got to resolve right now, which is that the jobs numbers, they look really good. I mean, these numbers look really good. But when you look at what's going on the demand side of the economy and the growth side of the economy, there's not a lot happening there. A lot of the Wall Street economists, I'd like to hear what Steve has to say about this, have been revising down their estimates for growth in the fourth quarter. It looks like the economy kind of limped out of 2015 the same way it did 2014, 2013. So once again, I think we're going into the next few months and people are going to be saying, well, how sustainable is this expansion in this job growth in a world where the economy isn't growing very strong? It's the same debate the Fed's been having for years now, and it's why I think they're going to move very gradually. With the earliest we can see them moving again at this point is March. They've penciled in 4 rate increases this year, but it might be less if the economy doesn't deliver.
All right, Steve, do you want to weigh in? As we know, strong numbers for Q4 don't mean we're going to have a strong 2016 necessarily.
Exactly. So that's why we go back to our base case scenario and we build out there. So our base case scenario is in that low, maybe mid 2% real GDP growth in the U.S. economy. That doesn't look like it's changed much given the numbers. Now, if the Fed were to get overly aggressive, which we do not see happening, we would have to revise that down. But the Fed is saying they're going to go 4 times this year. We'll use that as a base case. That might be a little bit aggressive. I think the Fed's going to look at the data very carefully. They're data dependent now. They wanted to be positive, so QE's done. They're positive now. Now they're going to start looking at the data much more than they would have previously. So the economy doesn't change a lot.
And how do you see the global uneasiness weighing in on U.S. corporations?
Well, I think we're getting a redux of last summer.
Yeah.
So the fears that we had last summer, oil, China, and global slowdown, we're getting a revisit of that, an echo of that in January. So I think the companies are going to experience that, but I think the dollar situation and the appreciation of the dollar, we see the dollar increasing in value this year as well. So that is going to weigh on global earnings when companies, they go abroad and they've got to buy dollars with those now weaker currencies. So we think that's going to be something of a headwind for multinationals, certainly.
Okay, some pretty good news this Friday. Steve Wood, John Hilsenrath, thanks to both of you for that.